All right, so today we have a special guest. This is one of those episodes where I've invested some time into researching some guests, and I wanted to talk about taxes, and especially we are at that time of the year when the old tax man's knocking on the door. It's getting close. I've got Craig Cody. He's a certified tax coach. He's a certified public accountant. He's a business owner. He's a former New York City police officer. He's got 17 years in the force. In addition to that, he's an accountant for the last 15 years. He's a certified tax coach. And again, I think this is one of those things where we've also got an author. So Craig's authored the best-selling book, The Secrets of a Tax-Free Life. And now we're talking about the 10 biggest mistakes, right, that cost business owners cash, right? We need to figure this out. So if you're listening to this podcast and you're thinking, gee, this is stuff that I want to know about, it's me too. I want to know as well. So without further ado, Craig, say hi.
Hi, how you doing? I'm glad to be here today. Thank you very much for having me.
Yes, and I appreciate you jumping on. I know this was one of those podcasts where we wanted, or at least I wanted to figure out a lot of the questions that you've brought up in your sort of outlay, which are related to tax planning and listening to your CPA, right? And then listening to your tax coach to make better decisions. And we all need to make better decisions in this place. There's a lot of changes going on. So let's just start off with what the heck is going on now with Trump? I know this is a big ball of wax, so I figured I'd ask it first because I know that's on everybody's mind. What is going on? What are the big changes that we should know about? And what do you think? What's your opinion? Better, worse?
Well, I think it creates a lot of opportunities for tax planning. Section 199, which is that everybody's heard of that pass-through 20% deduction that pass-through companies were going to be receiving. Basically, what that means is that practice owner that gets a K-1 at the end of the year for $300,000, he would normally get to take a $60,000 deduction off of that. So that's Section 199. But for some reason, what Congress decided to do is if you're a professional, a medical professional, there's an income phase out for that 20% deduction. So that creates a huge planning opportunities for doctors, dentists, professionals out there to make sure that their taxable income comes in underneath $15,000 income level if married joint filer. So it's really a good thing, but you need to communicate with your CPA and work on ways where you can make sure you come in under that limit.
So the limit is really the big thing that's the determining factor these days?
Well, for your typical pass-through entity, which is most business owners out there are either sole proprietors, single-member LLCs, S corporations, typically that's what you see. And for those businesses, they're looking at this Section 199, or they should be looking at the Section 199 income limitations and doing some planning as far as where are they going to fall. And if they're well under that number, then they have to look at other planning opportunities so they could, keep more of what they make. They're probably, like most business owners, working really hard.
So that Section 199, which seems to be the big discussion these days, is that the main thrust of this entire new Trump tax bill, or is there other things that are involved that we should know about?
Well, that would be the main thing that most people need to know about. I mean, they've expanded the brackets, they've lowered the tax rates, all right? But the thing that's going to affect people the most, if you're in business for yourself, is are you going to get this Section 199 deduction? So if you're a corporation, a C corporation, they've lowered the tax rate to 21%. But most small businesses, most medical practices are not C corporations. So they have to look at how are they going to take advantage of Section 199. And I rewrote my book for Section 199. I put a whole chapter on Section 199 inside of my book.
Awesome. So are you thinking most practitioners, and again, I don't know because I could do a tally up, but are they LLCs, do you think, or are they S Corps? What do you think the general traditional practices are going to be?
They run the gamut. They really do run the gamut. I can't say they're all S corporations. I can't say they're all LLCs. We find some that are LLCs. We find some that are S corporations. It really usually comes down to when they were ready to start the business, they sat down with the attorney, and the attorney said, "Okay, form LLC," and they formed it. No tax planning went into it. Instead of having the CPA and the attorney have a little discussion and say, "Okay, what works best liability-wise and what works best tax-wise?"
Correct. So I guess every practice is different on how they want to set up their structure. Do you have a preferred way of setting up businesses because of
N-
this new thing?
No, no, because everybody's situation is a little bit different. So you have to kind of look at that particular doctor's business. What else does he have going on, and what's going to work best for him? So, me and you can be in the same business. An LLC may work for me, an S corporation may work for you.
Okay, can you talk a little bit more about the limit since we were on that?
Sure.
Just to recap the number, and then what are the ways that people are considering going around this? And I know there's also a lot of talks about trusts and stuff like that today, which I would like to get into as well. But why don't you just go and just recap the limit, and then what are the ways to get around the limit, or if there are ways? I mean, I'm not trying to evade taxes. I'm just trying to pay less.
Right. Well, I think it was one of the Supreme Court justices many years ago said there's nothing illegal about planning to pay the proper amount of taxes. Okay. So what you want to do is the limit. Let's talk about the limits. For a married joint filer, this 20% deduction starts to phase out when your taxable income hits about $315,000, and when it goes from $315 to $407, it's phased out. For a single filer, it's half of that, so it's about $165,000 to about $207. So if you're going to be caught in that, you need to do some planning. And what types of planning can you do? You should sit down with your CPA or accountant and say, what can we do? Give me some ideas. Some ideas, are you able to segregate your income? Because if you're not a professional, or if you have another business that you're running that maybe would not fit in under the professional or the medical, then that business, no matter what your income is allowed to take that 20% deduction. Are there other tax planning strategies you can use where you could keep your income below the $315,000? Does it work with, charitable planning? Does it work with maybe setting up a management company and a C corporation? You need to just have that conversation and run the numbers and see what's going to work best for your business.
Okay.
And the key is communication.
No, I understand it. So a lot of people have been mentioning trusts. Is that something that's come up with you to get through this process?
No, that hasn't come up. I haven't seen that come up anywhere. And I'm part of a mastermind group that, we meet 3 times a year. We've already met specifically on this. I've never heard of using a trust for that. C corporations are a way to go because C corporations are taxed at 21%. And then when you take that money out, you're going to dividend it out at about, 20% again. But if you leave the money in there, it's almost kind of like the power of compounding. That's one option. It all depends on where your numbers are and what you need to do to get under those numbers.
Right. And then, again, I didn't mean to bring up the trust as a diversion. I just had heard a lot of people who had mentioned that. But I'm curious now, when you start to talk about the C Corp capability, are you talking about setting up a second business to handle, let's say, an overflow so that you manage that as a secondary business away from the original inbound cash flow?
Correct. Whether that's set up as a management company that's managing your business, maybe it's managing some of your real estate. Depending on how you set it up and how you document everything you're doing, as long as you make it legitimate, you can do that. So now you may be moving some money to your C corporation where it might be paying, the 21% rate, but your personal income is going to fall below the 315, and you're going to wind up with that deduction that you would otherwise lose.
Right. So that's a good thing you brought up about real estate, because a lot of people are holding real estate. There's a lot of questions now, I think, on is it the AMT that's going away, or what's the thing that's going away that a lot of people are screaming bloody murder over? I know there's something, because I know we have a bunch of properties. My family my wife and I have invested, and we're kind of thinking, like, I don't know, should we sell? Should we stay? There's a lot of deduction problems now, I guess. Again, I'm kind of just taking this out of thin air in discussions, and glad that you're able to help out.
So basically, with real estate, there are no real major changes that are going to hurt people. You still need to do your planning. You still need to look and see whether cost segregation makes sense. If you're making money on your real estate, are you if you're losing money, typically you're not going to get the benefit of those losses because it's called passive losses, and you have to have passive income to offset that passive loss. And unless you have other, let's just say, real estate that's generating passive income, those losses sit there forever. But if it's generating income, there are a number of different things that you could do, such as a cost segregation study and maybe get a one-time big depreciation deduction as a catch-up. But there's really nothing negative going on with real estate that I could point to.
Okay.
There are people that get confused with the interest deduction, the mortgage interest deduction. That might be what you're hearing.
I think that's what it might be, the interest deduction. But isn't that based off of your own property?
That's just your personal residence, correct. So if you have a business or rental property, that interest is still deductible, fully deductible, unless you get into some crazy numbers, which, for the most part, most people are not going to get into that.
Got it. So what are the other gotchas that we should know about? We've talked about the 199. We've talked about the that limit of 315. Maybe setting up a C corp. Is there anything else that we should know about from a layman's standpoint?
Oh yeah, retirement plans. Are you set up with the right retirement plan? Are you taking advantage of your 401k? Are you looking to couple it with some type of defined benefit plan? Are you working with the right people on a defined benefit plan, that people that actually really know the way these plans work and that can actually structure them so they're really beneficial to the owner? Because as an owner, you're paying payroll taxes, you're paying workers' compensation, you're paying all these things. All right, you're matching something for a 401k. Now, when it comes to a defined benefit plan, what you want to do is you want to really get something now that's really good for you, something that allows you to put as much money away as possible and not have to put money away for every single employee. And the problem is most people out there, when they go and they look at a defined benefit plan, they're not working with what I would call professionals that are really well-versed, and they're coming up with plans where they need to cover, or they think they need to cover, all these employees, when in actuality they don't have to cover all the employees. So they need to work with somebody that knows what they're doing. And we work with a number of people. We don't sell plans, we don't do plans, but we work with a number of people that are very good at analyzing plans and putting plans together so that the business owner really gets a big bang for his dollar.
What do you think the most, if you're going to say like the top 3 proactive tax planning strategies, what would those be, do you think, for a medical professional?
Oh, there are so many, but I mean, right now, planning itself is a big thing. The right entity, all right, is a big thing. You'd be surprised, how somebody may have the wrong entity and the amount of money that it could be costing them. Getting the right retirement plan, getting a defined benefit plan. Then you have things that add up. They're not huge things, but they're adding up. Like, can I hire my kids? Is it worthwhile? How much of a deduction do I get for that? How do I document it? All right. If I have real estate, do I have a medical expense reimbursement plan set up in my real estate? Because, what if my kids need braces? How do I write that off? Because those are things that I get a write-off for them, but I get no benefit on my tax return because the threshold is so high because of my income, I get no benefit. But if you have a medical expense reimbursement plan and you set it up the right way, now you get to write your kids' braces off. Maybe you're going for or you're going for some type of cosmetic dentistry, which turns into a lot of money. So just communicating with your CPA and letting him know what's going on and having him help you keep more of what you make. And if he won't communicate with you, find somebody else that will communicate with you.
Got it. And so those were 2 things. Did you want to say one more thing? Because I was wondering if maybe there's another top.
I mean, these are little things that add up. How about a home office? Do you have a home office? Most people I know spend at least about 15 hours a week working out of their home office, whether it's doing their billing, doing payroll, answering emails, reviewing records. Okay, the government says if you spend at least 15 hours a week in your home office, it's considered a bona fide home office, and then you could start writing off a percentage of your real estate taxes, which are currently capped, so that you'll get more of a deduction there, your mortgage interest, your utilities, your repairs and maintenance. It also makes now your commute from your one office to your other office deductible. And it may not turn into a lot of money, but it adds up. Up until December 31st of 2017, you were actually allowed to write off what we call a home athletic facility. So if you had a gym or a pool and you had a home office, you could actually write the cost of that off. But that went away under tax reform.
Mm-hmm. Okay. And then why do you think, if of all the things, what do you think of all is the top mistake or the biggest mistake? I mean, we've talked about proactive stuff, but now let's talk about what mistakes do you constantly see, or do you see are one of the thriving areas of, I'm sure, of your practice when people come to you?
You know, they do run the gamut. They really do. It could be the business they have chosen the wrong business entity. They've done no planning at all, and a little bit of planning could help. Have they hired their spouse? Have they set up a 401k with their spouse? That's an extra $18,000 a year they get to put away and deduct. And I'm sure the spouse is doing work in the business, so it's legitimate. Just really not taking the time to plan. And they look at accounting fees as an expense item. They should really be looking at them as an income item. Because if you spend the time and you're working with the right person, he's going to uncover things for you, and it's actually going to save you more money.
That's a good point about the kids stuff. So, a while back, there's a lot of movement towards these college-bound programs, and I forget the exact number, but there's a plan that's specific for them. Is it still worth it to do these college-based things, or is there better returns in the market in general? Because I've heard different varying opinions, and then just with kids that are now becoming close to going into high school, I'm thinking, boy, if I had done that, originally, maybe I had a better deal. But I've been told that if you haven't done any really tax savings in those college-bound types of programs, that it's better to put it in the market or put it in a better vehicle that can get you better returns at this point.
Right. Well, every state has a different plan, so it really depends on the state. But typically, you're getting a deduction only on a state level. And when you're talking about need-based aid, having a 529 plan is going to hurt you for need-based aid. But if you're a typical medical profession, your children are not getting any need-based aid because you make too much money.
Gotcha. So the
wonderful
529 has a cap or something like that involved in it?
No, there's no cap as far as your income, but there's a cap on the amount of money you're allowed to put in every year. And it's not deductible on the federal level. It's just on a state level. But the one nice thing about the new tax regulations is 529 plans can now be used for high school.
Really?
Elementary education, yes. So they made a change with that. So that's where people are getting a little bit of a bang. And if you're in a high tax state like it's New York or New York City or New Jersey or California, that could be somewhere around 13%. So it adds up. It's something. And we have clients now that they're using that money to fund the high school, the private high school. We have clients that they're paying their kids to work, and then they're using that money to fund the Roth IRA at an early age. So there's a lot of different things you could do. You just need to really take the time to plan. And there is no panacea. There's no one thing. It's usually a bunch of different things. And some of them can be big dollars, and some of them can be, not so big.
So, I keep asking this same question I've got a CPA, I've got a business consultant. Everybody has their listeners. What's the difference between a certified tax coach and an accountant, let's just say? Because it sounds like there's some different variances in there to some degree of how they're kind of maybe one's in one corner and one's in the other corner. Does that make sense?
Right. Yes. Well, a certified tax coach, a tax coach is somebody that's been through a number of days of training and then goes through additional training on a regular basis year after year. So I do about 15 days a year of training. Some of it's through my organization, Tax Coach. Some of it is through a mastermind that I run for people that do what I do. Okay, so we're up on all the latest ideas that are out there where we could save our clients money. So it's somebody that's looking to be proactive and looking for ways for their clients to really, to keep more of what they make. People work hard. If you could keep an extra $20, $30, $40, $50,000, that's a wonderful thing. We saved a client one year $450,000 in tax.
Wow.
And there was no rocket. I mean, he was making a lot of money, but there was nothing there that was rocket science. It was just that we took the time to go through and find some ways for him to plan, and he saved a lot of money. But the average doctor is saving somewhere between $20,000 and $50,000 a year.
Right. So,
and that's a lot of shoes.
Yeah. Well, yeah, and I think the other part of this is, I think just the setup. We work with a lot of people who are coming into this business. They're moving from a traditional employment with a hospital or employment with somebody else. They're coming in as an entrepreneur. They're getting started. And of course, there's so many different variations on how to think through the process of how do you want to set this up. And I've been an LLC, I've been an S corp, and now I think I'm going to end up a C corp. And I'm wondering if there is, when you talk about someone coming into the business, if you've got a recommended plan. So let's say they're starting off today, they're going to start the business. They're going to be running let's say a medical spa, and they're going to set up equipment. And do you typically get into the routine? I mean, for an S corp, I know the thing that I liked was that I could pay myself a salary. I could still take withdrawals from the business, but there was definitely an advantage because of the tax rules on having once I've secured a salary, the employment status changed with the S corp on how the deductions are wrangled. And I guess I'm sorry I'm mangling this to death, but I think you kind of
I understand. Yes. So ideally we want to be involved from the beginning, but that's typically not the case.
Right.
Because most people are already operating a business before they realize that they need somebody to help them out. There are some younger people. We just started with a dentist, a periodontist that just started a business. He bought a business out west, and he had the wherewithal, and he had been working for someone for a number of years. So he had heard us, and he called us, and so we helped him, choose his entity type. But a lot of times you can actually correct those things retroactively and save some money.
So if I'm in the middle of this year and I say, you know what, I'm an LLC and I've not done this correctly, I need to be an S corp, C corp, or whatever, or I need to change things around. It can go retroactively during the year and change over for that year, I would think.
If you do it correctly and you follow the right regulations, yes. We've probably done 50 to 75 of those.
Got it. So I think that's a big thing for people to listen to on this. And I know we have a lot of people who are going to perk up on that one, which is that, you can change this stuff midstream if you do it the right way. And I'm sure there's some timeline. Are there any guidelines or timelines that someone should know about in order to make those changes? So if they were to engage with someone like yourself to start to have that, discussion to open up the sort of, hey, this is what we got. Can you make, retroactive changes for this year, especially because I'm thinking a lot of people make different decisions based off of how they've got their income flowing based on the Section 199.
Correct. So Section 199 starts in 2018, but those retroactive elections, we are typically making them, as long as the client, meets the criteria, we would make them retroactive today through January 1st of 2017. So if a client came to us and we had, a set of facts and circumstances, and we felt that they met the requirements, we could actually make that retroactive to January 1st of 2017.
Awesome. So that's good news for anybody who's like concerned about the fact that they may have been thinking about this and they were concerned about a timing perspective. And I bet you a lot of this is just due to maybe not necessarily that people don't know about it. It's just that I think it gets pushed to the side because
it's not rocket science. Most practitioners are well aware of it, but they're also so deep into it this time of year, and they're not talking with their clients throughout the year. So when they see their clients at this time of year, it's just a matter of getting, the right numbers in the right boxes and ending there versus taking the time to plan. And, we like people to communicate and take the time to plan, and that's where they save the big money.
That's awesome. So I want to start to wrap this up, but so do you have sort of a punch down list of those 10 most expensive tax mistakes, or your book title basically, says it all, which the real, top 10, could you bang those out in order of magnitude?
Well, yeah, I mean, failing to plan, audit paranoia, Section 199, the wrong business entity, the wrong retirement plan, missing hiring your kids, missing a medical expense reimbursement plan, missing a home office deduction, missing your car and truck expenses. So I think that, and I guess the last one would be missing my help or that of a good practitioner.
Got it. Perfect.
Yeah.
So now we've got, because of the relationship, obviously we've been having this discussion, and I think it's kind of cool. We do have a special for those people. So you talk about the book itself, and then I'll give people the link they can go to get to the book.
Sure. Our book, we actually rewrote the book for the new tax changes, and it is called The 10 Biggest Tax Mistakes That Cost Business Owners Thousands. And we go through the top 10 mistakes in that book. And those are things that you can discuss with your CPA, or you could, reach out to us. But these are things that people are missing, and, it's really all about keeping more of what you make. And there are some things in there that we didn't put in there. That can be done, that can turn into even bigger dollars for clients. But we kind of kept it to, something that does, pertain to pretty much all business owners.
Got it. And so you're giving this book to anyone who goes to the page, which is Craig Cody and Company. That's Craig, Craig, Cody, Cody, and company.com/medical marketing. And this will be in the podcast. So if you don't have a pen and you're driving or running on a treadmill right now, which I typically do, you can go back to this episode and you can actually go to the notes, and we will have this link in there for your book from Craig's company. And Craig, anything else that I didn't ask or should have asked you? This is super informative, and I know there's a lot behind this, and I'm sure we could talk technical details, but I think more importantly, they should get in touch with you to start a real discussion for tax planning and paying less, right? And we all know the government has their hand out for sure in this world that we're in today.
Exactly. Keep, you work hard, keep more of what you make, and the government allows you to do it. And there's so many things you can do, and why not keep it?
Yes. And has anybody ever said that you sound a lot like Ray Barone?
I actually have heard that before. But they tell me I look like Brad Pitt.
Yeah. Okay. There, you got a nice visual for you folks. So again, everybody, thanks for tuning into this episode. We've had a great discussion with Craig Cody. Again, if you're looking to get the book, there is a link here. Again, Craig Cody and company.com/medical marketing, and you can pick up the book. You can certainly go to his site as well and get in contact with him. And is there any other places where you think there might be good content to coordinate with you at all, Craig?
Sure. Yes. And before I give you that book is a real paper copy of a book. And if they go to our website and they can look at our blog, there's a lot of good content in there, and we post a lot of different things, where you could learn and see what you can be doing to save more money.
Good. Love saving money. I love the tax discussion. It's super needed. I think it's on everybody's mind right now. I know it's on mine. So I'll be definitely talking to you. So good. It's great having this discussion, and we look forward to maybe catching up to you in a little bit further down the road as we get into maybe 2019 and the changes that will probably end up happening after we get through 2018 as we kind of get through this first year of the Trump world and enter our next framework of really the first time, at least I've seen some positive movement, I think, in the tax reform.
Yes, business owners have a lot on the line there, so it's about time that they get rewarded, and they should, make sure they're working to take advantage of those rewards.
Cool. Very good. Thanks, Craig.
Well, thank you very much for having me. I appreciate it.
Okay, so look, if you want to get some help, I'm here to assist you. You can get into our quick coaching session, 20 minutes. You can just jump on my calendar, go to CustomerBloom.com/apply and jump on my calendar. Really easy. Just try and get yourself to think through getting mentors. If it's not me or somebody else, if you need to move ahead, the only way to do it is to work with people who've been there. As just a practitioner of doing business for a long time, don't burn your eyeballs out trying to figure this out on your own. Have someone guide you. It's well worth it, and the time you spend in just short conversations go miles and miles of the distance. I've done it. I'm doing it now. I'm working with very high-level coaches, and I suggest if you work with someone who's ahead of you, you're going to get a lot further quicker. All right, so again, CustomerBloom.com/apply if you'd like to talk about coaching with me.